Speaking of Joe Lavorgna, counselor to the Treasury Secretary, to discuss this. Joe, it's great to have you on to kind of flesh this out a little bit. And I guess, first of all, most important would be to get at what the drivers of this narrower deficit are and whether they're structural, whether they're durable, whether they're going to continue. Because, I mean, you hear things about, obviously, tariff revenue, pretty high capital gains tax collections, and then some maybe foregone spending that maybe was appropriated. So what's in it and what's going to continue?
Sure. Thank you, Michael, for having me. The reason we went from April to September is because the fiscal year, as you know, starts in October. So that last year, or the last quarter of 2024, which was under the Biden administration, 40% of the deficit was in that one quarter. That's a 10-year high. Then if you include the first quarter, because when that administration's in, they're signing contracts, there's projects, grants, et cetera, that are working through the system. You can't immediately try to slow the rate of spending. So in the first quarter of fiscal year, second quarter rather, fiscal year 25, we had 34%. So basically, in the two quarters that overlap with the Biden administration, 74% of the budget deficit occurred then. From April forward, two things happened. One, as you mentioned, you had tariff revenues. We're going to probably collect something in a calendar year of about $300 billion. It's an annual rate of nearly $400 billion if you look at the last few months. But what's important, Michael, is that on the spending side, spending year on year in the third quarter of this year was basically flat, up 0.2, and it was down 2.5% in the fourth quarter, or the last quarter of the fiscal year. So the spending trajectory looks very key, and that's why the Republicans do not want to cave to Democrat demands to reverse these spending initiatives, which are going to keep a much better deficit trajectory in place thanks to President Trump's policies.
Joe, I see a lot of the Wall Street research and economists writing about 2026, calendar 2026, and why we should expect some of the stimulative effects of the OBBB coming through. And one of those is expected very heavy individual tax refunds in the first quarter, $150 billion or so, incremental to last year, as well as a lot of the corporate tax incentives. I guess what I'm wondering is whether you're getting the benefits on the deficit side this year because you're kind of over withholding by design and you're giving it back next year. And also, you know, can we extrapolate the spending levels from this past quarter into next year?
So, Michael, on the OBBB, the full expensing of capital, those guidelines, I believe, are almost done. The full expensing for factories, which is very important and will drive domestic production and tax revenues, that's still being worked on. We do need this shutdown to end because at some point we're not going to be able, with the IRS and Treasury working on this, they're not going to be able to fully implement everything in time if the Democrats keep the government closed. So that's important. In terms of the refunds next year, yes, they could be very meaningful for workers, but their incentive, Michael, is to work more. For tariffs, we're going to generate a lot more tariff revenue next year. And given where the economy has been, you know, we're looking at 4% type of growth for the third quarter, 3% plus type growth next year if we get this CapEx, everything in place as we expect. That's a boom. That's going to drive the revenues. Now, on the spending side, Michael, we don't know. We're very optimistic that the last 6 months have put us on a better trajectory. That's why the Republicans want to make sure we don't add back in all this frivolous, inefficient spending that was removed from the OBBB. So that will depend on how negotiations go. I'm hopeful that the trajectory of spending, Michael, is less. And with the strong growth, we can get this budget deficit to GDP ratio down to 5, maybe even the high 4s next year if we get the boom that we're expecting.
Do you expect tariffs to provide consistent revenue or be a one-time benefit to the deficit? Because I know the administration has basically said that tariffs are a one-time price adjustment. So from an inflation standpoint, the view is that it will be kind of a one-time boost and then things will settle down from there. And I'm curious if you're expecting the same thing on a revenue collection side.
Sure, Leslie. I mean, right now, if you look at the CPI or the PC, we haven't even seen that price level effect impact tariffs in any meaningful way in aggregate. But your point is well taken that if it shows up, it would be a one-off price level adjustment. But the tariff is still in effect. So we're generally generating about $30 billion, $30 billion plus per month in tariff revenue. So that will remain in place. Now, over time, over a period of years, if there's more reindustrialization, there's more domestic growth through factory expansion, CapEx, all the things that are part of the bill, then domestic revenues are going to rise. Production goes up relative to consumption. And then organically, years from now, you may get less tariff revenue, but the point is you get more domestic revenue. So right now, these tariffs will continue to generate the revenue in the near term that we're looking for, somewhere in the $300 to $400 billion per annum level.